Closed and open input-output model, introduction, structure, components, and solution. Introduction to closed and open input-output model. This model was developed by Vasily Leontiev in the 1950s. The first input-output model was formulated in Leontiev, 1936, where Leontiev constructed the corresponding table for the economy of the United States for the year 1919. And later on the one for the year 1929. In his work he visualized the economy of a whole country as if it were covered by one huge accounting system. This representation helps to predict and analyze effects of changes in one industry on the other industries. Leontiev was awarded a Nobel Prize in Economics in 1973 for the development of this methodology. Input-output analysis is an economic model that is used to study interdependencies between different sectors of an economy. It is a popular model in economics, planning, and policy analysis. The model recognizes that the economy is represented as a system of interconnected sectors. Each sector produces/supplies goods and services, i.e. their outputs, using input from other sectors. Hence the model's interest is to understand how changes in one sector influences other sectors and by extension the overall economy of a country. The input-output analysis is a theoretical framework to quantify the mutual interrelations among industries in a nation's economy. These relations can be represented by tables or matrices. The input-output analysis tells us that there are industrial interrelationships and interdependencies in the economic system as a whole. The inputs of one industry are the outputs of another industry and vice versa. So that ultimately their mutual relationships lead to equilibrium between supply and demand in the economy as a whole. It is assumed that a major part of economic activity consists in producing intermediate goods, inputs, for further use in producing final goods, outputs. There are flows of goods in whirlpools and cross-currents between different industries. The supply side consists of large inter-industry flows of intermediate products and the demand side of the final goods. In essence, the input-output analysis implies that in equilibrium, the money value of aggregate output of the whole economy must equal the sum of the money values of inter-industry inputs and the sum of the money values of inter-industry outputs. Closed model. In a closed input-output model, the entire production is consumed only by the productive industries in the economy. This model favors the intermediate demand only. If the exogenous sector of the open input-output model is absorbed into the system as just another industry, the model will become a closed one. In such a model, final demand and primary input do not appear. In their place will be the input requirements and the output of the newly conceived industry. All goods will now be intermediate in nature, because everything is produced only for the sake of satisfying the input requirements of the N+1 sectors in the model. Open input-output model. While in an open input-output model both the intermediate and final demand are satisfied, both the producer and non-producer benefit. Besides the N industries, the model contains an open sector, say, households, which exogenously determines a final demand, non-input demand, for the product of each industry and which supplies a primary input, say, labor service, not produced by the N industries themselves, then the model is an open one. Again, suppose that there exists another sector of the economy that only consumes goods and services, i.e. the open sector. Leontiev model. Intermediate consumption net final demand total output industry 1 industry 2 industry 3 industry 1 x11 x12 x13 y1 x1 industry 2 x21 x22 x23 y2 x2 industry 3 x31 x32 x33 y1 x3 value added v1 v2 v3 total input x1 x2 x3. In this open system the final demand is considered as exogenous, so there are factor endowments, like labor, that have to be paid. This is reflected in a production function. Leontiev uses a special production function where the inputs used in producing a product are related by a linear and fixed coefficient production function, i.e., Zij equals Ij xj for Ij equals 1, 2, n. The matrix A equals Ij, n times n is called the matrix of inter-industry coefficients. According to Nations, 1999, the assumption of linear and fixed coefficients can be justified on the notion that a technique of production will not change much over a short period and, even if it does change, the engineering data or statistical data collected by censuses on inputs utilized by an industry, which represent a new technology in an input-output column, can be obtained to replace the old column. Industry 1 Industry 2 Industry 3 net final demand 11 at 12 at 13 y1 Industry 1 Industry 2 y2 at 21 at 22 at 23 Industry 3 y1 at 31 at 32 at 33 value added v1 v2 v3. JTH in this table, the entries of the column indicates the amount of input of each kind that is required to produce 1 unit of output of industry J. On the other hand, the entries of the ith row indicates the amount of output from industry I to produce 1 unit of output of each kind. When the final demand Y is included, we get the basic input-output model, that can be expressed in matrix form as AX plus Y equals X or IA, X equals Y, 1. For this equation to hold, it is required not only the inverse of IA to exist, but also to be non-negative. Note that the total output X and final demand X are non-negative, so it is also logical to require the inverse of IA to be non-negative. Rao and Rao, 1998, points out that if the matrix IA is non-singular and non-negative, then a non-negative solution to the system is given by X equals IA 1Y 2. Is here IA 1 called the Leontief inverse. It is also known as the multiplier matrix or matrix of multipliers. Summary of input-output analysis. Input-output analysis describes the interdependent supply chains between sectors within an economy. The input-output analysis table quantifies the flows of outputs from one industry, in rows, as inputs into another, in columns. In the input-output analysis model, the total economy-wide impact of an economic event can be analyzed from the initial demand change and its direct, indirect, and induced impacts. Input-output analysis is often used in Marxist economics as an economic planning method. Input-output analysis is the appropriate model for managing the balanced development of the economy. Relevance of the model to determine the output levels of each sector to meet both the intermediate demand and final demand. Understanding sectoral linkages is valuable in understanding supply chains, identifying bottlenecks, and assessing vulnerabilities to external shocks. Policy evaluation to evaluate the effectiveness of different policy interventions and investment strategies. This helps plan for economic development of a regional or country economy, estimating the economic wave effects of policy changes, policy makers, planners, etc. It can help make informed decisions and prioritize investments that yield the highest economic returns. It is useful in assessing the impact of various shocks or policy changes in the economy, e.g., the effects of an increase in government spending, a change in trade policy, introduction of new technologies, etc. Understanding the effects of decision-making involving key sectors. Computing the gross national product (GNP). Types of model. Input-output models are one of the most versatile tools used in economics, extensively analyzed not only in intersectoral interactions but also in production and economic impacts. Different types of input-output models have been developed to respond to specific analytical requirements and developed for different uses and situations. Static input-output model. Dynamic input-output model, regional input-output model, multi-regional input-output model, environmental input-output model, social and inter-industry model, static input-output model. Static input-output model is the basic original model presented by Wassily Leontief. It considers coefficients of production to be fixed and independent of time. The model is a snap characterization at the moment of inter-industry relations, providing direct information on the economy's structure and sectoral flow of goods and services. It finds wide applications in the analyses of economic structures, policy evaluation processes, and comprehension of the dynamics of supply chains. Dynamic input-output model. The dynamic model is a deviation from the static model. It accommodates the changes that take place due to time, dubbed in technological improvements or changes in consumer preferences, or even policy prescriptions. Dynamic model allows the production coefficients and economic parameters to vary over multiple time frames. This in turn allows economists and policy makers a free hand in simulating long-term effects of economic policies, forecasting future economic trends, and analyzing impacts of dynamic changes on sectoral outputs, employment, and economic growth. Regional input-output model. The regional input-output model analyzes economic interactions within a region of interest, typically a city, state, or country. The local model allows slight variations of the basic IO structure to articulate regional production functions and consumption patterns, showing a range of differences across regions and of regional interdependence in the form of buying and selling patterns. Proves useful for purposes of regional economic planning, gauging the regional aspect of infrastructure projects or policy changes and pointing out the burgeoning key sectors within the region. Multi-regional input-output model. The multi-regional input-output model extends this regional approach to the case of the analysis of economic interactions of n regions or countries by pooling input-output tables of the various regions or economies in order to study cross-border trade flows, supply chain interdependencies, and international economic interconnectedness in much greater detail. The model is an extremely important tool in the analysis of world economies, assessment of trade policies, and interpretation of the effects of globalization on national and regional economies. Environmental input-output model. In other words, the environmental input-output model supplements the IO framework in incorporating environmental factors and the use of resources in the model. Indeed, it is important to quantify the environmental effects and resource depletion associated with energy use, greenhouse gas emissions, and depletion of natural resources from economic activities. This makes it particularly applicable in planning for developments that are sustainable, as well as evaluations of environmental policies and strategies for the benefit from economic growth processes. In doing so, It certainly empowers policymakers and business to operationalize the environmental considerations which should be embedded within the economic decision-making processes. Social and inter-industry model. Social and inter-industry model is an IO framework that adds dimensions of what society looks like at a social level and the inter-industry level. It involves employment, wages, and income distributions across various sectors. It studies how economic activities impact society's social results and inequalities. The applications can be found in designing apt economic policies that provide effective distribution, review of labor market dynamics, and examination of socio-economic implications due to changes in sectors. Features of Input-Output Model. The IO model is an effective analytical tool for the representation of the intricate interconnections existing among sectors of an economy. Built originally by Vasily Leontiev in the 1930s, it has since metamorphosed into basic framework for the description of economic relationships, production process analysis, as well as the evaluation of economic policies and external shocks effects in an economy. Transaction matrix. Production and consumption flows. Sectoral interdependencies. Multiplier effects. Economic impact analysis. Transaction matrix. The centerpiece of the input-output model is the transaction matrix that quantifies the extent of exchange of goods and services among the sectors of the economy. This shows the transactions each sector purchases from each of the others and to whom they are sold. It affords an overall view of economic transactions. Essentially, the model assists economists in examining the flow of inputs and outputs from and to various sectors, at the same time making it possible to be able to pinpoint the key linkages and dependencies that come to characterize the structure of the economy. Production and consumption flows. The IO model distinguishes between production flows, which embody inputs consumed by sectors for their production processes, and consumption flows, which refer to final outputs sold either to other sectors, or sold directly to final consumers. By mapping these production and consumption flows, the model captures the distribution of economic activities across sectors and points out the sectors that are suppliers versus those acting as consumers within the economy. Sectoral interdependencies. The input-output model is useful in representing intersectoral relations. The model can therefore indicate how changes experienced in any given sector are transmitted to the entire economy. Particularly, this feature comes in handy for economic resilience in showing which other sectors are going to be affected further by an attacked particular sector of a disruption and the other sectors that are going to take the lead in maintaining the overall economy stable and growing. Multiplier effects. Most researchers consider multiplier effects as the key concept in the input-output model. Multipliers usually explain the resulting impacts of a change in spending or production in some industry across the economy. The effects measure the amplification of economic impacts and indicate the linkage between various sectors. Multipliers are very important in the analysis of economic policies, especially when the policymaker is seeking to evaluate the broader economic implication either as an intervention or investment. Economic impact analysis. There are a number of occasions on which economic impact analyses using input-output models are used to provide an understanding of how different activities, policy alterations, or economic shocks will bring about effects in diverse parts of an economy. Scenarios and their effects on alterations in the distribution of production, employment, and incomes across sectors are simulated so economists and policymakers can assess the benefits, costs, and trade-offs related to various policy alternatives. Assumptions of input-output model. An input-output model is a powerful analysis tool in use by economists to explore interdependence among sectors of an economy. First proposed by Vasily Leontiev in the 1930s, this model builds on some important assumptions that take into account the intricacies involved in economic relationships, which can make a meaningful quantitative assessment of the production processes, consumption patterns, and economic impacts. Fixed coefficients of production. Linear relationships. Aggregate demand and aggregate supply. Homogeneous goods and services. Time invariance. Fixed coefficients of production. The implicit but basic assumption in the input-output model is related to constant production coefficients in all the activities of an economic system. This means the proportion of inputs, be it raw material, labor, and capital required to produce a unit of output at any point in time remains unchanged as time lapses and output levels fluctuate. While this assumption simplifies the modeling process and then allows for the straightforward calculation of intersectoral relationships, it might oversimplify real-world complications, where production technologies and input requirements can indeed vary with scale and technological advancements. Linear relationships. This further assumes that changes in demand for each sector's outputs, if any, are, therefore, proportionally matched by changes in demand for the inputs of all other sectors. For given quantities of goods and services demanded, and for good or for sign whichever is stipulated by the context. This is a convenient assumption for the simple reason that it allows easy computation of the multiplier effects, among other things, and the study of the production chains. Still, It might very well entail neglect of deep-seated seemingly nonlinear production functions and economies of scale in the practice that actually are part of the hearing of practice input-output relationships. Aggregate demand and aggregate supply. The model also equally assumes that aggregate demand equals aggregate supply, which is true for all sectors through time. This property, as a mark of equilibrium, denotes that the given economy is working at full capacity, with all available resources strategically used in the process of producing goods. This allows for the determination of overall economic balance and the distribution of production across different sectors, but may not be a proper representation of the fact relating to normal oscillations in supply and demand conditions such as recessions, shortages, or excess capacity. Homogeneous goods and services. Another assumption in the input-output model is of homogeneous goods and services within each sector. This means that units of a certain good or service, at least within a sector, are of a similar makeup in their qualities and characteristics, which makes it possible to aggregate outputs and inputs among sectors. While this simplification assists in the construction of input-output tables and the analysis of sectoral interactions, it may miss out on the diversity and differentiation of products within sectors, which can be crucial determinants of market dynamics and economic outcomes. Time invariance. The input-output model, therefore, assumes production coefficients and economic relationships to be time invariant in the short to medium-term period. The meaning of this assumption is that the structure of an economy captured by input-output tables will hold constant over time for the analysis and projection of the links between sectors to be done continuously over time. This would not capture dynamism of technology, consumer preference, policy interventions, or even external shocks which by themselves change the structure of an economy and in turn modify production patterns and economic relationships over longer time horizons. Limitations. Constancy of input coefficient. Its framework rests on Leontief's basic assumption of constancy of input coefficient of production, which was split up above as constant returns of scale and technique of production. The assumption of constant returns to scale holds good in a stationary economy, while that of constant technique of production in stationary technology. These assumptions sacrifice reality. They do not treat the inter-industry analysis dynamically, even in the so-called dynamic model. It tells us nothing as to how technical coefficient would change with changed conditions. Again, some industries may have identical capital structures, some may have heavy capital requirements, while others may use no capital. Such variations in the use of techniques of production make the assumption of constant coefficients of production unrealistic. Assumption of fixed coefficient. This assumption of fixed coefficient of production ignores the possibility of factor substitution. There is always the possibility of some substitutions even in a short period, while substitution possibilities are likely to be relatively greater over a longer period. The assumption of linear equations. The assumption of linear equations, which relates outputs of one industry to inputs of others, appears to be unrealistic. Since factors are mostly indivisible, increases in outputs do not always require proportionate increases in inputs. Rigidity. The rigidity of the input-output model cannot reflect such phenomena as bottlenecks, increasing costs, etc. Excess focus on production. The input-output model is severely simplified and restricted as it lays exclusive emphasis on the production side for the economy. It does not tell us why the inputs and outputs are of a particular pattern in the economy. Notion of final demand. Another difficulty arises in the case of final demand or bill of goods. In this model, the purchases by the government and consumers are taken as given and treated as a specific bill of goods. Final demand is regarded as an independent variable. It might, therefore, fail to utilize all the factors proportionately or need more than their available supply. Assuming constancy of coefficiency of production, the analysis is not in a position to solve this difficulty. No mechanism for price adjustments. There is no mechanism for price adjustments in the input-output analysis, which makes it unrealistic. The analysis of cost-price relations proceeds on the assumption that each industrial sector adjusts the price of its output by just enough to cover the change in the case of its primary and intermediate output.